Here with me now to discuss is Tony Pasquariello, Goldman Sachs head of hedge fund coverage. Great to see you, Tony.
Thanks, Mike. By. Great to be with you.
We've known for a while that this sort of path to the hoped-for soft landing, I've been saying, it's narrow, it's bumpy, it was no guarantee, maybe gotten a little tougher in the last few weeks. How are markets situated relative to that outlook?
Sure. So I think if you take a quick step back from some of the noise, I think the tough setup for the market is the Fed is tightening into a slowdown. That's kind of the hard truth of the hand we're playing right now. And they're not, of course, they're not doing it for the sake of form. They have an inflation problem. They're taking the fight to inflation via tighter financial conditions. So in a way, what we're seeing in the markets is what needs to happen. The further you go along that path, the tighter financial conditions get, the more you worry about the prospect of a hard landing. So we're not there as a house yet. Jan Hatzius, our U.S. economics team, over the weekend, though, they said, look, the probability of a recession over the next 1 year is not 15%, it's 30%. Over the next 2 years, it's not 35%, it's 48%. And you can see whether it's some of the sell-off in commodities or the fact that break-even inflation rates stopped going up, the markets more comprehensively have started to wring their hands about, again, the prospect of a hard landing.
Is it not a little bit of a comfort that the markets are in those ways trying to say that maybe inflation is less the thing to worry about right now? And then I guess it would require a leap to then say maybe the Fed's a little closer than we had feared to where it has to go.
I think that's right. I think the hard part for the market, though, is the moment the Fed basically says we're done, or what's priced into the strip is as far as we'll go, the minute they let off, the market's going to rally back and will ease financial conditions in the doing. And that's the kind of the cat and mouse game between the Fed and financial conditions, the Fed and financial markets.
Powell today did, of course, give acknowledgement to the fact that, yes, financial conditions have tightened quite a bit, and the markets have reached a certain point where prices in their outlook. But he said, but we have to deliver it in order, I guess, to retain credibility and really to have the effect that they're looking for, which means time. I mean, more than anything, right? I mean, you could say the market's down 24% at the lows. Credit spreads have done what they've done. Hedge fund positioning, I mean, you know this as well as anybody, really defensive right now. So you could build a bullish case, but it's a matter of how long do we have to wait to get clarity.
You nailed it. The markets have done a lot of work. Just witness, to your point, S&P starts the year on a 22 PE in the 97th percentile valuation. We're now down on a 16. Not yet quite at the long-term average, but we've done a lot of work. Positioning, there's no doubt about it. If you observe our prime brokerage data, which is a pretty good teller of truth about where hedge funds are, gross exposure, net exposure, as low as they've been in 5 years. Last week, record selling through our franchise. The front end has done a lot of work. If we were doing this interview at the start of June 2021, kind of before Powell made his initial pivot, the 2-year note yielded 15 basis points. It traded nearly 3.5 last week. So that is the good news. I think the challenge, though, again, is, to your point, the Fed funds rate as we speak is 1.50%. Headline CPI is 8.6%. And so the Fed still has to deliver. And I think it's in the doing where the markets are just going to continue to feel that pinch from the Fed.